Thanks for joining David and I for the market update for the month of January.
Harry, how did the investment markets do last month?
Investment markets actually, as we all know, finished 2021 in a super strong way. Unfortunately, January was a little tougher. The markets didn't fare particularly well in January. Canadian market was slightly off. The U.S. market, the Dow was down, maybe 3.3, 3.4%, somewhere around that region. The high-tech area really got sort of beat up in the month of January. They were off about 9%. We had a little bit of a mixed bag in Europe, and the emerging markets were definitely also a little beat up for the month of January. David, why did the equity markets experience a sell-off in the beginning of 2022?
Yeah, I think equity markets, the main thing driving equity markets in January was investors digesting the interest rates movements and also inflation. As we know, inflation has been persistent and elevated for the last 12 months at the very least. The most recent reading for inflation was at 7%, which is pretty high. So everyone is aware of inflation. Everyone is aware that financial conditions are going to become tighter and interest rates are going to start going up. But the Federal Reserve and also the Bank of Canada, in their comments in their monthly meetings, have kind of telegraphed that rates are probably going to go up even faster than they had indicated maybe 2 months ago. And so, of course, the markets are extremely efficient at digesting this sort of stuff. And so investors were selling equities to sort of price in the fact that rates are going to go up a bit faster than was first forecasted. What areas of the market were most impacted in January, Harry?
Yeah, I'll get to that in a second, David. I just wanted to add a little bit because I couldn't agree with you more about inflation. But I think the main thing, too, is that people just don't like uncertainty. And, we do have a lot of that uncertainty around right now, as you mentioned, with inflation rates and what interest rates are going to do, supply chain issues, Omicron. There's just so many things that create this, and that's probably one of, adding to what you said, is just creating this a little bit of uncertainty. And we sort of saw that same play, in 2020 in March and April. Markets were reacting 2 to 3 times worse than they reacted now. And, we all know the good end of the story to that one.
Mm-hmm.
But what areas sold off the most in January? Definitely the high-tech, healthcare, and even some of the more speculative things like Bitcoin. They just got absolutely clobbered in the month of January. What did a little bit better? Well, traditionally what happens in bad markets is people go to safety. And what are those safety areas? Well, the dividend-paying side of the investment, the financials, the telecom, the consumer staples, all held up really, really well. And even, I missed the energy sectors, all did really, really well. David, do we expect a bounce back from this?
Yeah, I think so. And perhaps the bounce back may already be underway. The last 2 trading days of January both had very strong positive results. So that kind of helped to stem some of the losses. Like the losses obviously were, mid to high single digits for most markets in January, but they were even worse there maybe a week or so prior to the end of the month. So the bounce back could already be underway. Chances are the markets have to a large degree already priced in where interest rates are going to be now 12 to 18 months down the road. There's always a chance the Fed has to hike rates even more than they've indicated, although the market is already pricing in quite a few hikes between now and the next couple of years. So to a large degree, that's probably priced in. As the rate hikes actually start to unfold, both the Bank of Canada and the Fed are probably going to make their first hikes in early March. We may see the markets react to that again in March, but they know it's coming now, and they have a pretty good idea of where it's going to trend from here. So, all the time, companies' share prices follow earnings, Harry, and, earnings are still pretty robust for a lot of companies. As you mentioned, all those defensive sectors, energy's very profitable right now. Financial institutions are going to become more profitable as interest rates go up. So there's definitely certain parts of the market that should be just fine as interest rates rise. Obviously, if the Fed or the Bank of Canada raise rates too aggressively and economic growth, like earnings per share, doesn't keep up, that could weigh on markets a little bit. But the Fed's aware of that. Their mandate is to control inflation, Harry, but also make sure unemployment is low. And so again, if they go too fast, too far, in raising rates, that will have an impact on the economy, and they may have to revisit that and dial it back again.
Yeah, those are great points, David. And, we've seen this rodeo before, as I've mentioned before. Markets always go up and down. The nice thing is most of the money managers had a lot of cash in their portfolios, so they were able to take advantage of these dips. And we always know the market's going to come back and move forward again. It's just a matter of how long does it take? Is it going to happen this month, or is it going to happen in another month after that? So again, one of the things about being a good investor is also be patient through these short-term volatility time periods. But as always, if you have any questions, you want to review anything with David or myself, please don't hesitate to give us a call.
Take care.
Bye-bye.